I'm joining you today from the AllianzGI core fixed income team to discuss the latest thoughts on unconstrained global fixed income markets. My name is Luke Copley. I'm a product specialist for the Allianz core fixed income team. In response to the latest Fed speak on the scope for a 0.5% increase in policy rates, compared to the usual 0.25% hiking increments that we've seen in the last 20 years, we have recently revised our targets for when to engage with long duration views again. The Fed's desire to act quickly and in larger steps could trigger rates to overshoot now, near term. So our first review level to reconsider buying US 10-year yields is now around the 2.5% level, although we do recognise that any significant overshoot could well trigger a spike more towards 275. So for now, we are being nimble with our target setting, keep reassessing our fair value estimates, plus our assumptions on the terminal Fed funds rate for this cycle. Being close to neutral duration risk, or marginally short of neutral as we are now, feels like a good place to be. And we can be patient, perhaps a little greedier on the yield levels we wish to see before implementing large directional duration views. Interestingly, the Fed Chair Powell recently cited Fed research which suggested that the spread between today's 3-month T-bill rate and 3-month rate 18 months forward was a better predictor of forthcoming recessions. This is in sharp contrast to the historic research that's been focused on curve spreads at longer tenors, such as the 2s 10s or the 5-year versus 30-year. That 3-month Treasury forward spread is currently trading around 2.5%. The steepest since records began. Clearly, the Fed's focus here highlights its near-term bias to get towards a neutral or even potentially restrictive policy stance in a hurry. As a result, we're looking to engage with curve flattening trades, i.e. selling the front end of the curve and buying the back end. There is a question as to how much the market believes this Fed narrative, given some inversion elsewhere along the curve, for example in 5-year versus 10-year. We can see that the market is challenging the longer-term growth forecasts here and the scope for growth to soften in future, albeit perhaps not into recession territory. Much has been made recently of the prospects of stagflation and therefore a return to 1970s economics, although it's worth pointing out that today's job market, savings dynamics, today's dollar environment are all very different from back then. We're expecting an unusually short and non-conventional cycle, but not a protracted period of true stagflation. However, if energy prices and inflation do persist at high levels for the rest of the year, at some stage we should expect headwinds to growth, and the stag part of that stagflation equation will definitely come into sharper focus. It's this next potential cycle phase that could see safe haven bonds and duration rally strongly. So whilst our near-term outlook is for upward pressure on yields, a quite conducive backdrop for adding credit risk, we know that we need to be nimble in evolving our strategy to a longer duration, more defensive posture as the cycle turns. We have the flexibility to position for both of those environments. And so this is the big dichotomy facing investors right now. The 3 to 6 month horizon could play out very differently to the 9 to 18 month type of horizon.
Allianz Global Investors.